almost everyone from nearly everywhere is talking about the possible recession that is knocking at our door. But I would like to take approach to this and wonder what are the indicators and also ratings that may really prompt us to think that the problems are ahead of us. Maybe that's quite of a just a noise, or maybe there are some real concerns worth worrying about. So today we would like to approach a ratings regarding US economy, also ratings regarding global economy and stock market. So after a longer break, I invite you to another episode of Blockrevision. Let's begin. Right, so at first let's have a look at some of market movers, and we are going through previous data of a trading economics regarding what happened to economy of US and other major countries that has major impact on global GDP. So let's have a look at first United States. Yeah, that's already been set, and we'll start since 20th of April of 2022. So right here at the top we have existing home sales, and we can find there is a major downturn move right there. If we just head a little bit closer, we can find this major slump on this gauge. As we can find, existing home sales is a very important indicator of a consumer sentiment. So we can find that this one in a 5-year spectrum is heading back to the levels unseen before a pandemic. So it looks like more declines are imminent in the upcoming months. That's what Lawrence Yan, chief economist of NAS, had stated. As of next, let's have a look at durable goods orders, and this one had its tough times on February. Right now has recovered a bit, but still bearing a some of a chance of getting been slumped in the next month. So that's not also optimistic, but it's not something that we should be afraid of. New home sales, and this one is absolutely crushing. Right now we have a major recession regarding this gauge, and new home sales is also a very important regarding where the economy may be going, whether it's contraction or expansion. Right now we are contracting regarding recent times, so we are heading back towards those second half of 2021 period where this gauge was about 700,000. Alright, so we have as of next GDP growth rate, and it's a very important one in order to verify whether we are heading into recession or not. Recently we've seen that this gauge has contracted, and we have had also a contraction back then before right after this pandemic outbreak, and there we've seen that it was really a crushing time for us. However, we were going through a quite of a different economic background, where we could print out so much money that Fed could really recover the economy, if we could say this, in a very rapid pace. So the next period of third quarter was a very robust regarding the other terms. So this one may be a quite of an indicator of an upcoming recession if we just appoint another another negative quarter, that will point that we are probably in a recession time. And as of next, we had personal income, and this one has gone through quite a positive time regarding those social benefits and other aspects. We can find that we are still in a positive territory. However, this time of very easy money being given out here and there has respectively to the past gone, as we can find the possibly maintaining the personal income at the same level as here during previous months, and maybe a bit more tough. As of next, we have a personal spending terms, and this one is quite positively good. So it means customers are not afraid of a possible upcoming recession, and we can find this here, where such expenditures as traveling and dining hasn't really suffered during recent time. And we can find that the only one previous quite of a bad time was during when pandemic was had its second wave and has frightened some of investors. Right now we are still in a good condition, so it's something building up. Alright, and we have ISM manufacturing PMI, and this one, however, has shocked, and right now we are going very far in terms of possible slowing down of an economy. Now let's have a look at ISM manufacturing PMI, and this one is really shocking, as previous 10 years is showing us that we are heading into a real slowdown regarding those gauges. We can find that we are right now very close to 50 points. That means we are still in a bullish territory. However, the pace of this slowdown is really increasing, and gives us some of justification of that it may be very troublesome, and it get more troublesome in the nearest future. All right. As of next, let's have a look at JOLTS job openings. That's really building up, and is showing that the strength of the economy after this pandemic time has returned and is getting back to a much better period. Right now, let's have a look at ADP employment change, and this one has really shown us that United States is getting back and showing labor market recovery, which is a sign of getting economy a full employment state very soon. The full employment regarding the time previous pandemic outbreak. So right now we are on the way. Let's jump right next to balance of trade, and it's really disgusting. Right now we can find that disrupted supply chains right now is showing that we are in a very tough times, the worst times since the time and this gauge have been created. So right now there are massive deficits, and that's the one of the that leads to the one of the conclusion that the only thing that may calm down those deficits might be a exactly possible recession. So sharp increases right now are seen in purchases of finished metal shapes, crude oil, cotton apparel, and household goods, and so on, and everything is in a massive deficit. And also lockdowns in China just increasing the pace of problems. As of next, we have ISM manufacturing PMI, and this right now is in a also not very optimistic after this massive robustness time. Right now we are heading back to 50-ish area. Right now we are still in a positive territory. However, there's a still high probability of getting lower, at least to the levels of those been seen before pandemic, or even lower if those problems with Russia-Ukraine war will continue and will affect material costs and other, whether it was fuel or chemicals. Okay, as of next, let's have a look at non-farm payrolls, and right now it has stopped. Literally, we can find that on a 5-year spectrum we are seeing right now quite of a slump, and this one is leading us to another conclusion, that the slowdown may get worse even when the full employment is right here and right now. We still can find that this inflation is prompting more employers to quite of a tough times regarding also those payrolls gauges. So the employers adjust, or companies adjust, cutting the expenditures whenever they can. Right next we have unemployment rate, and this one is very low, so it's exactly the good one, as we have just been delivered. Right now we are in a very good state. However, it doesn't mean that it's one of the gauges that should rescue us from a possible slowdown in economy. Right now we can find that there is more people ready to get work, but the economy is heading south regarding its prosperity. Okay, so as of next we have very important inflation rate, and this is very high. Right now has slowed down. Some of the economists say that we have already peaked. However, it's still unless it will drop, we can find that this inflation may become elevated throughout not only this but also the next year. So the something that may be worrisome is that we are still increasing the pace with a substantial way. We can find that the previous time of such high inflation has been seen in early 80s. As of next, we have core inflation rate year over year, and this gauge also has peaked recently, but we are still in a quite of a substantial levels regarding that 6.5 has been seen on March. We are still above 6, and there's nearly nothing to slow it down unless the recession will turn up and will slow down and pace of a economy and how it really grow fast. Okay, up next we have Michigan consumer sentiment, and this exactly gauge is showing us that consumer sentiment is quite good, as we have stated previously, but it was for April, and right now we can find that we are still in this quite bearish phase, where we have turned back to this environment of around the war, Russia-Ukraine war. So we are in a very rapid downturn. However, those levels should be maintained maintained unless we will see a very abrupt like a breakdown on the other gauges such as inflation or rising interest rates. As of next, we have a housing starts, and this one is still climbing up. Oh, sorry, not this gauge. Let's have a look a bit closer. We can find that we are still climbing up and getting slowly but surely to those levels of 2006. However, getting to those levels will be much more difficult, in my opinion, as affordability of houses has lowered recently. Okay, so building permits, let's have a look. That's something that may be much more problematic if it will get worse. However, right now we are still in a very similar path to those of the previous gauge, so it means there is nothing that may stop the housing markets as of right now. Okay, and the next one for US is existing home sales, and this one has slumped, really slumped. So right now the housing market is cooling, and we can find that there are less and less buyers regarding those cases. So sales went down, and also the interest around this market has gone down. So to sum up, in US we can find that we are in a quite of a problematic time where there is a real anxiety around where the economy will go in the next months. We can find that also Fed raising interest rates may contract an economy a little bit, and also this forecasting quantitative tightening that may happen just at the beginning of June may also speed up this spiral of negativity around the economy. So that's very important to watch as how the Fed will react to those different terms, and I will inform you in the coming sessions and series. And right now I'd like to switch to DXY, that is US dollar currency index, showing us the real strength of US dollar. Right now the money is getting back to risk on asset, that is definitely a US dollar. Right now we are struggling with another resistance that has been set at 105 points. Right now let's have a look closer at what is happening in euro area. So right now these are the top gauges around Europe where the most the strongest economy is German one, and the second is France. All right, so we have also here. All right, so here we have a look at, and right now I would like to have a look at trade, and right now I'd like to have a look at what is happening with Europe's economy. So we would like to have a look at euro area gauges, and as well two strongest economies above all. There is Germany and France. So two of them right now is pointing much of a slowdown, such as in US. German manufacturing PMI since the second half of April right now is reversing itself, and in a 5 years period right now we can find that it's getting weaker and weaker, and it has a little even reverted back to 2017. However, as we can find, manufacturing PMI had its problems in Germany even back then in 2019. So that's not really a new situation, right? Back then, Germany had its more pessimistic outputs being noted right in that period. Okay, let's have a look at another one. Business climate in Germany right now is also very weak. Right now we have slowed down to the levels not seen since 2011, right before this global crisis occurred. So right now, during this quite turbulent time around the problems following the war in Ukraine, we can find that according to economists, we are struggling with getting the climate index positive. Alright, for the next we have Germany JFK consumer climate, and this one is showing also very downward pressure. That's something really unbelievable. Right now we are forming like an M pattern that is showing us that we have slumped into a nearly minus 30 points. So that's around inflation and also other aspects regarding war in Ukraine that has impacted such of a gauge. Right now, since this indicator been first published, we haven't seen this one since 2000 year. GDP from Germany, there is a growth rate. Right now we are oscillating between all levels, positivity and negativity. So it will be very important to watch this gauge in the nearest future. Germany GDP annual growth rate right now is still positive, but it will be difficult to maintain its positive pace in the months to come, quarters to come. Right now we can find that there is not threatening situations, and we should stay above zero territory. Alright, so we have of next Euro area GDP annual growth rate, and this one exactly is around 5 points and still showing some strength. However, the next month will show up whether Euro area has overcome the real shadow of a possible recession. And there's Euro area GDP growth rate, and it's still positive right now. Now let's have a look at Euro area inflation rate, and this one is heading even above 8 points. That is highest since its existence. And the European Commission sees inflation at 6.1% in 2022 before falling to 2.7% in 2023. That's very optimistic scenario regarding that there is still quite of a long path to hike interest rates in Euro area, as Christine Lagarde says. And right here we have Euro area unemployment rate, and this one going downturn, with this one correction being caused by an pandemic outbreak. Right here we have Germany balance of trade, and this one has also slumped, same as in US. That's something been caused by disruption of supply chains and the problems regarding of imports coming up from China. And here ZTW Economic Sentiment Index showing us that Germany right now is heading into very tough time, and we are suffering to that extent we have been suffering throughout the first few weeks of pandemic. Right, let's right now have a look at what is happening with euro currency. right now we can find by these gauges that we have just discovered that euro area might be in a quite higher problems regarding this Russian invasion, and also some of a higher or lower interest rates decisions that may devaluate the euro currency even in a higher pace than in terms of US dollar. So it means that right now we are just after breaking out of this symmetrical triangle that is right now pointing that we might be heading back downwards into even territories not been seen since 22 years. So right here we can find it in May. If we just won't have a quite of a decent reversal candle being built right here, this doji candle would be a quite of a invitation to bears that there is still much lower to go for euro. So right now we are still trying to defend this 1.035 area, however struggling, and we can see this. Alright, and that's everything in this episode. On Monday, however, I will just show you out another gauges that will show us how the other important key economies are going and how they are struggling or performing in these tough times. So there will be Japan, there will be Australia, and also Great Britain, to name a few. And I will just give you another very important gauges to watch. So stay with Blockrevision from now on. The episodes will be broadcasted regularly. So thank you very much for watching for today, and see you in the next episode.